So just to kick off, everyone get out their phones because the first question is actually going to you guys in the audience. We're going to have a polling question. Go to the polling site, have it up on the screen, BloombergInvest.app. Get ready. This is a market check. So yesterday, the quiet period ended for the 29 underwriters on the Uber IPO. The analysts at those banks were allowed to give out their first price targets on the stock. It was all over the board. But what do you guys think? Will it be flat, up, down, or at $62, up about 40%? That was the highest price target on the street. So.
Real time, right? That seems like a verdict.
Okay, great.
That's pretty cool.
That is cool.
So not some bears out there for Uber. Makes sense. But my first question is for Kristin because it's actually her first day today in a new role at Barclays. So congrats on that, and I'm grateful that you're here with us to kick off your new gig. But clearly, investors have been disappointed so far with some of these high-profile IPOs like Uber. What does that mean for the private companies in the pipeline?
Yeah, that's a great question. I'm really optimistic in terms of the pipeline for the back half of the year. There are a few reasons for that. Number one, there are a lot of really great businesses that are still private, much larger than companies typically. If you go back several years, companies are going public later, partially because of the availability of capital in the private markets, and so companies are coming to market now. Larger, better capitalized, closer to profitability. So there are a lot of great businesses that are still private that I expect to come out. Secondly, the tech IPOs and all IPOs actually as an asset class continue to outperform the major indices. And so if from a standpoint of launching a new IPO, it's nice to have the asset class as a whole working. And then I think the third thing is there's a huge appetite still for growth, and it's hard to find growth in the secondary markets. And so I think that's something that's happening in the U.S., but it's also a global phenomenon. We've seen an incredible interest in growth stocks out of Europe, particularly as of the last couple of years.
So the other banker on the panel, Sam, this one's for you. Mm-hmm. How are investors thinking about companies' growth versus profitability? Uber, for example, lost $1 billion last quarter. But what's the pendulum? Where is it swinging between growth and profitability right now?
Great question. And I think as Kristin alluded to, growth is still what investors are focused on. However, I do think the pendulum swung towards a path towards profitability. So either you're profitable or you can see a path over the next N number of quarters towards profitability. I think underwriting, unlimited losses is something that investors are definitely double-clicking on. A lot of the IPOs that have come out in the recent past, investors have been peeling back that onion to really do the work to understand what the long-term model looks like and what the long-term margin profile looks like. So I'll say that tech companies, for sure, investors are focused on, are you investing to retain or grow your market position? And that means you've got to subsidize that growth via marketing expenses, costs, or R&D investments, absolutely. So that pendulum has swung back, though, towards more rationality over the last few quarters, for sure.
I think there's one thing I would add is just that as investors look at companies going public, it's not 2 quarters, 4 quarters, 6 quarters from profitability. There's not a magic number. It's more, are you raising enough capital in the IPO to fund yourself to profitability and to meet all of your growth objectives without having to come back to the equity market? Because they want to know that you're kind of bulletproof from that perspective if they're making an investment at the IPO.
So some of these more bulletproof IPOs have actually been lesser known companies, a lot of enterprise software names, less high profile than an Uber or a Lyft. Zoom Networks has done great, PagerDuty. So I want to throw this to Alex. Alex, you helped advise PagerDuty this year. So why is this corner of the market doing better?
We did. Our firm worked with PagerDuty and very proud to do so. I think you could argue, the statement that every company is now a technology company, you can say in many cases every company is a software company. And when you get a mission critical software a terrific application and a huge need like PagerDuty, you see an outsized interest in an IPO, and you can see outsized returns for that. So I think the software category generally is, we're going to still see very high levels of capital markets activity. Obviously, cloud-based solutions are, all companies are moving that direction. So I think we're going to see, we see a very robust continued pipeline in software specifically. And as you said, there's a lot going on in the enterprise. While some of the more consumer names can be flashier and attract a lot of media attention, there are a lot of companies that are serving these mission-critical applications, and those are going to provide outsized returns.
A few more clients
we do.
this year.
We have CrowdStrike. We're working with CrowdStrike and Fiverr, which are both on their roadshows right now, and we think the pipeline is extremely robust.
Let's talk about the hot new thing right now, direct listing. So June 20th, Slack is going to go public via direct listing. We've seen Spotify do this, but are your clients kind of asking you if this is a viable solution, or is it only an option for a select few companies?
I'm happy to take that. Look, I think the direct listing is interesting for certain businesses. I think if you look at the entire private company landscape, there's a very small percentage of companies that could actually go public, I think, through a direct listing successfully. Yep. There are a few things that you kind of need to have to be successful in that. Number one is having a strong institutional shareholder base of crossover guys before you go public, and I think we've seen that in both of those examples. But look, I mean, today we're allocating, in most cases, in technology IPOs, we're allocating 45% of the order book to the top 10 investors. And so if you have 10 really strong crossover type investors that are going to continue to be buying the stock once you're listed, I think that's a great foundation. That plus having enough scale to where the liquidity in the market once you do list is going to be sufficient enough for to have something meaningful that you can that the institutions can actually build a position. And the third thing that helps is if the business is actually consumer facing in some sense, because then you also get the added benefit of some retail trading activity once the company lists to help with liquidity.
But does a direct listing edge out investment bankers? Are you guys worried about not being needed if this becomes popular?
I think it's a very small percentage of companies, I think, that actually will pursue this as a listing mechanism. I think more companies will continue to go around. It's literally a couple percent, I think, of the companies that could go public.
I completely agree with Kristin. It's a small percentage of companies. You've got to be a company that perhaps does not need primary capital at the IPO, because you're going to go out and do a secondary listing for the most part. Banks are involved. Even with Spotify and with Slack, banks are involved in helping with some of that. So I don't think you're edging the banks out per se, but it's the fact is the vast majority of companies, both international and the US, are going to be using banks to go public. So I don't think that's off the table.
And I would say if you actually look at the fee information that's in these documents, you'll see that they're not considerably cheaper from a service provider perspective or a banking perspective than what you would see with a primary capital raise.
Yeah, I'd also just add that, I think all those points are really important. And Sam, many investors still don't, or at least retail investors don't realize that companies are not raising capital in these direct listings. And that's so I think there can be an overreaction among investors and in the media when a couple of companies do something, and then there's a overreaction to say, well, all the companies are going to do it now, and that's for all the reasons that people articulated. That's just, we don't believe that's going to be the case at all.
And I think there's been a long list of situations where folks have tried to look for alternatives to traditional offerings, whether it be Dutch auctions or things like that, and I would say with mixed success, frankly.
Yep.
We certainly need a good lawyer, when it comes to a direct listing. But follow up on that legal question, dual class shares. It's still pretty controversial. There's some pushback from investor groups. It's a few years now since Snap, but how are companies thinking about dual class shares when it comes to their shareholder structure?
Sure, good question. I would say that with every late stage private company that I work with, it's certainly a question that is at least asked. Oftentimes, companies will have implemented a dual class many, many years prior, actually. But certainly those that haven't will look at their cap table and say, does this make sense for us? And there are a variety of reasons why it may or may not, depending on the nature of the cap table. I would say our recommendation tends to be, if you're dealing with a founder-led company, where creating some amount of control structure will facilitate long-term vision, that in general, that's an easier path. I think if you have a broadly distributed cap table where a dual class structure can have all kinds of unintended consequences down the road as you concentrate that high vote, because it always converts to a low vote stock as it's transacted. So I think we try to model that, but it certainly is hard to predict ultimately how that will play out. And I think also, you need to implement a reasonable sunset. So at some point, I think investors need to be given assurance that that dual class is going to fall away, whether it be voting concentration decreases or time-based. And so but I would say, we have that conversation with every late-stage client.
I'll jump in there. I think when you go on the road, investors are far more focused on the business model and the company and the prospects. This is just a tangential issue so far. So if your company is a company that's trying to push its way to an IPO and you have dual class shares, clearly that becomes a much bigger issue. So this is, at least in my experience, has been more of a tangential issue.
Yeah, and I would say with respect to the point on indexes, these structures always have the ability to collapse them from a legal perspective. So the general perspective that I've heard as companies consider the impact of those new positions is, if and when that's a problem for us, it'll be a good problem and we'll collapse the structure in order to facilitate the listing.
Yep.
What are the high-profile ones still coming up this year that do have a dual-class structure? I heard Pinterest maybe. I know Lyft had one. Any of your clients have a dual track? Okay.
I would say, the pipeline that I see, and obviously it's anecdotal from my perspective, but I would say 60-70% of my late-stage clients are going to have a dual class as they go out.
And that's, across tech IPOs in general, you're looking at kind of 60% of companies have that dual class. And it's usually 10 to 1, right? So as long as you kind of stay straight down the middle, it doesn't typically come out as a question on the roadshow.
Got it. Well, let's switch gears to talk a little more globally. Mm-hmm. So at Bloomberg, we broke news on Alibaba's IPO listing in Hong Kong. Crystal Tsay was the reporter. She's in the audience, so pat her on the back at some point. But is this a game changer? What does this mean if companies are now looking to other exchanges for their IPOs? Bill Ford, the CEO of General Atlantic, told this conference yesterday that he thinks we will not see another Chinese company list here in the U.S. because of the trade war.
Look, I think maybe I can start and other folks can jump in. We're still seeing Chinese tech companies looking to go to the U.S. as the source of capital markets, so that's still the case. The broader trade war, which is what I think people are alluding to, is having an impact on the broader Chinese economy in terms of how the stocks are trading in the Shanghai or the Hong Kong Stock Exchange, but not so far on the tech companies per se. So they're still looking at the U.S. exchanges as a way to get out there, have their story heard by probably the most sophisticated investor base, and get a valuation that truly justifies their business model. I think Alibaba looking to go back and do a secondary listing in Hong Kong is just a focus of the Chinese government, and the government's looking to say, let's make it easier for companies that were traditionally not looking to list in Hong Kong to come back and be able to list. There were some specific structural things that Alibaba had that had limited it. I will say that going forward, will companies look to go more domestic? That's always been the case. We took a company called Adyen public, which is a financial technology company that didn't choose to list in the US or in Europe, but listed in this domestic exchange of Amsterdam, and it did fantastically well. It's a $15 billion company and has done well. So I do think listing in foreign exchanges is not a new phenomenon, but I still think first things first, investors look to list in the U.S. from my perspective.
Yeah, and in the technology market, I think, especially as it relates to Chinese companies, whether they're listing in the U.S. or in Hong Kong, investors can kind of invest across different exchanges. So it doesn't limit the investor base necessarily, and it doesn't limit U.S. institutions in necessarily investing in a company listed in Hong Kong. I think as it relates to Chinese tech IPOs in general, last year was a really big year for Chinese for Chinese companies listing in the U.S. in particular, but just Chinese tech IPOs. It's slowed down a little bit this year because some of the performance has been mixed, but it's a really important part of the global tech market, and I think it'll continue to be something that we all focus on for the next several years.
If this trade war does kind of roil the markets, what would you recommend to private companies, your clients waiting in the wings? They're going to have a short window after Labor Day. Timing is everything in IPO. Could you talk about that if we do see some market uncertainty?
I think it's trying to time the market is extremely challenging. And so one of the main points that we make to clients is to be prepared and to have the optionality. An IPO is a lengthy process, and there's really very significant advantages to getting to know the buy side and the sell side and the bankers and all of the important influencers in the ecosystem well prior to an IPO, and then to get the process going. It's a very, as I said, time-consuming and intense process, and you want to create that optionality, and then be able to capitalize on when the window is open and market opportunities. I think trying to look 3 or 4 or 6 months ahead and time the market is very challenging. So be ready, and then you can take advantage of those opportunities.
I would say from a legal perspective, the ability to do most of these deals confidentially now has made a huge difference in companies' willingness to start a process. It used to be the case that as soon as you filed your S1 or your F1, your financials would be available to the world and to competitors, customers, et cetera. And I think the process that for the vast majority of companies that are going public now, a process that allows them to go through the regulatory review and the other preparations in a little bit more of a stealth mode has facilitated people getting ready regardless of market windows.
It's also, I think, the IPO has become much less of a fundraising event because the really good tech companies that are coming public are so well capitalized from the private markets when they come public that it's much more of a liquidity event for shareholders, and employees ultimately. It's an M&A currency, and it's a branding opportunity in a lot of ways. And so so the deal sizes as a percentage of the market cap. Years ago, you saw tech companies kind of going public and selling 20% of the market cap of the company at IPO. You're seeing a lot more companies going public selling 10% of the market cap of the company. So the shareholders are a little less sensitive to the dilution caused by the IPO. It's less of a fundraising event, and so there's a little bit more willingness from the shareholders in terms of just getting public, seeing that as an entry point to being public, and not necessarily trying to time the market, which is always our advice as well, is don't try to time the market. Really good companies can kind of get out in any market.
On that point about the floats getting smaller for companies, how do you design a book for an IPO to get that pricing pop that people want? What are the factors that play into that?
Yeah, when you have smaller deal sizes, the challenge is making sure that the top shareholders, the really high quality mutual funds and some hedge funds in some cases, have a big enough allocation to make it meaningful enough to them to where they'll continue to follow the company and build on that position over time. And it gets more challenging when you have a smaller deal size. But companies are spending a lot more time during testing the waters, getting to know these management teams, or getting to know the buy side better. And so part of that's kind of done before we go out. I think in terms of designing a book that trades well, the IPO discount or the expectation for high growth tech companies used to be a stock that would trade up kind of 15%, the IPO pop or the IPO discount in essence. These days for high growth companies, the expectation is closer to 30%, which you can see in the kind of filed or the offering to current price performance in most of the tech IPOs. And so you're seeing, we're allocating the book probably heavier at the tops. The top, I said before, top 10 investors are getting typically 45% of the allocations. Top 20 investors, somewhere between 60-65% of the allocations. But that does often, produce an aftermarket return closer to 30% than 15%.
I would say on the pricing committee calls that I attend related to IPOs, management teams are much more involved in the allocation process, and I think that not so much for me, but for Kristin and others, educating management with respect to the need for those kinds of considerations will certainly have a significant impact on post-IPO performance in the near term.
Go ahead.
Sorry. I think what Jamie's saying, don't take the last dollar off the table when you're trying to price the IPO. You've got to leave a little bit in there for the investors that are coming in. You're only selling less than 10% of the at your IPO, so this is not the one price that's going to make or break your company. So think more long term. The other thing I would say, and sorry, Alex, is we are advising companies, and I know Kristin's doing the same thing as well, to spend far more time with investors even before the IPO process starts. You're talking about 12, 18 months before. Get out there, have your story be told with the right legal caveats in place, and build a relationship with investors. So when you meet the investors during testing the waters or during the IPO process, it's not the first time that you're meeting the investor, because you want them to be comfortable with the story, how it's progressed over time, and post-IPO, you need them to be long-term shareholders. That's the whole point about the book building process and going public.
Yeah, and that was what I was going to say, is that we've got data that correlates that the number of times that a company meets with key investors prior to the IPO roadshow can indicate more that they become better longer-term holders. And that correlation is quite clear. So as we were just saying, I think building those relationships early, and one of the top complaints from the buy side is they don't want the IPO roadshow to be the first time they met a company. And so really, really important.
And I would say, actually, I see certainly with non-deal roadshows, at least those 12 to 18-month conversations that are happening, a lot of these companies are unit economic based at this point. And so getting the feedback from the buy side with respect to how they view the necessary unit economic presentations, what are the metrics, how should the company be thinking about narrating its business model, is something that we consistently encourage our clients to go and do well in advance of the IPO.
Yep.
So this is all designed, these long-term relationships with the buy side, to prevent against shorting, let's say. But is that working? Because there was a lot of attention this year around different short products that came out later. Like, how do you really prevent against that? Is it possible?
I guess nobody wants to jump on that question. Look, I think it's you're building the relationships. Your stories can be understood by the investors. Shorts and folks that focus on shorts are always going to be playing that game. From our perspective, and others can jump in, we want to make sure that the upside potential and the true benefits of the story are heard by investors. And that's the reason we get out there and we talk to the long onlys. We aren't taking the company to go talk to short investors to help them build their short thesis per se.
Great. So just to wrap up, I'm going to put you guys on the spot for a quick lightning round. In one sentence, no more than one sentence, tell me what is the top advice you're giving clients, private companies this year when it comes to an IPO. Let's start with Alex.
Start early, be prepared, and take the time, invest the time to meeting the people around the ecosystem that are going to help you going forward.
Yep.
Sam?
Very similar, but I think the top advice is be patient. Don't rush out for the IPO, and go when you're ready.
I would say invest in your board, invest in your management team, invest in your business. Do things that are going to have applicability for both an IPO or a capital raising event, but also for enhancing your business.
And I agree with all of them, but I'd also just add, come to the market well capitalized so that you have the leverage, and you don't have to, you have the leverage when it comes to the buy side.
And that's it. Thank you very much. Very interesting.